By March 1st, BlackRock will hold more Bitcoin than MicroStrategy. This prediction from a Twitter user caught our attention. It suggests that BlackRock will enter the top 10 list of entities holding the most Bitcoin within a few weeks. Beyond just predicting what's happening, which isn't always spot on, it really gets us thinking about how the market's changing, especially this trend where we're seeing a ton of Bitcoin piling up in company reserves and investment funds. We've talked about this before in our past videos. It's pretty clear that Spot Bitcoin ETFs are a big deal. They offer a bunch of perks, and they're definitely attractive and will keep attracting a whole lot of investors. The fact that you can access them from any regular trading platform, not having to stress about managing your private key and seed phrase, plus the tax benefits they bring to the table, make these ETFs the go-to choice for most folks these days. Just on December 29th and 30th last year, over $500 million worth of Bitcoins got scooped up by the 11 Spot Bitcoin ETFs that are approved here in the States. BlackRock and Fidelity are grabbing the biggest slice of the market, with each holding over $2 billion in Bitcoin reserves as of right now. They're still way behind Grayscale, of course, which you can see in blue on this chart. BlackRock's in green and Fidelity's in pink. You might be wondering why Grayscale's reserves are dwindling while their competitors are filling up. There are a few reasons for that. First off, before it turned into an ETF, GBTC was just a simple trust. Don't ask me why, but in a trust like Grayscale's, they could regularly create new shares by adding more Bitcoin. However, the opposite wasn't possible. You couldn't just show up with your shares and ask for your Bitcoin in return. This is what's known as the redemption mechanism. For years, this led to either a discount or a premium on GBTC compared to the actual value of the Bitcoin Grayscale had in reserve. As you can see on this chart, in December 2022, GBTC was trading at almost a 50% discount. So basically, you were buying a share of GBTC for $100, which theoretically entitled you to $200 of Bitcoin. So we say theoretically because, as previously mentioned, you couldn't actually withdraw them with a trust. We hope you've been enjoying our videos for those who've been following us for a while now. And if you're new here, welcome. Here at GA Crypto, we are passionate and focused on giving you the most up-to-date info on the crypto ecosystem in order for you to take control of your finances. So if you'd like to hear more from us, hit subscribe, that little bell underneath the video. Okay, let's jump back in. A bunch of people took a gamble, betting that this gap, the discount, would close up once GBTC converted into an ETF. The moment the SEC gave the green light, all these folks were knocking on Grayscale's door to cash in their Bitcoin. Let's break it down with some made-up numbers so you can get a clear picture. Let's imagine in December 2022, I buy one share of GBTC for $15,000. This piece of paper theoretically gives me a slice of Grayscale's BTC reserves. In my case, it's worth 2 BTC. But these are locked up until, hopefully, the fund transforms into an ETF. On January 11th, right after the SEC's decision, I go back to Grayscale to get my 2 BTC in exchange for my share. This is one of the many reasons why we're seeing a drop in the number of Bitcoin at Grayscale. A lot of big investment funds have played this card in the last few months, racking up huge profits in early January. Another factor driving investors away from Grayscale and their GBTC are the fees they charge. They're about 8 times more expensive than, say, Bitwise. In any case, we're not going to spend the whole video on Grayscale. That's not the main topic. Today on GA Crypto, we'd like to take a step back and think about the concentration of Bitcoin in these ETFs. Are these super simple and accessible financial products a threat to Bitcoin? Richard Detent touched on this a while back and shared his view in his Grand Angle Eco videos a few weeks ago. Sorry guys, but unless you speak French, this video won't make much sense to you. But here we're going to take a slightly different approach. We'll revisit one of the examples he mentioned in his video, the case of emails and the SMTP protocol. Nowadays, almost everyone is pretty much forced to use the GAFAM software for sending and receiving emails. According to a litmus.com study published last December, Apple, Google, and Microsoft together own almost 95% of the market. That's huge. Yet the basic communication protocol, called SMTP for Simple Mail Transfer Protocol, was originally designed as an open architecture system, aiming to provide a decentralized means of communication on the internet. So here's the million-dollar question. How did we end up here? The beginning of the story of the SMTP protocol starts with the very beginnings of the internet. In 1966, the DARPA, a research agency of the US military, kicked off the ARPANET project to develop a decentralized computer network. It was launched in 1969 and would become the technical core of today's internet. ARPANET connected military bases, universities, and research centers together. There's this popular belief that in the context of the Cold War, the project aimed to keep communication networks up and running in case of a Soviet nuclear attack. However, ARPANET's official goal was more about making it easier to share resources among researchers. Over time, several protocols were developed to send messages through the ARPANET network. But it was the SMTP protocol, initially published by John Postel in 1981, that became the very foundation of email communication. As its name suggests, SMTP is a very simple protocol. It establishes a connection between two servers, identifies the sender and recipient, sends a message, then manages the receipt and closing of the connection. In its early days, SMTP prioritized reliability over the security of exchanges and didn't include any authentication or encryption mechanisms. As a result, each SMTP server acted like an open mail relay, vulnerable to various attacks, including spam. One solution could have been to switch protocols and to start from scratch, building on foundations that meet current needs. But SMTP was already too big to fail. The complexity of transforming all the processes dependent on this protocol and redirecting everyone to a new solution was too daunting. So the decision was made to add extra layers to the existing protocol. In the mid-90s, new standards like eSMTP and SMTP AUTH were adopted, integrating layers of authentication and encryption. Around the same time, we saw the creation of the first blacklists of servers and IP addresses to combat spam. Entities like MAPS, Mail Abuse Prevention System, took the lead on this, despite controversies around the approach. SMTP began to gradually centralize because these lists encouraged users to relay their emails via a recognized internet service provider. The need to manage sender reputation and adapt to an increasingly complex email environment favored the rise of specialized intermediaries. And it's really important to know that if you try to break out of this mold and run your own mail server at home, for example, Gmail, Outlook, and others won't let your messages through their servers. Thus, the era of the SMT protocol, simple, free, and open as it was in the early days of the internet, comes to an end. SMTP has turned into a highway between major distribution centers. This story shows how a series of small technical decisions made benevolently in response to emerging problems can lead to unintentional but significant centralization. Of course, there are some technical similarities between Bitcoin and SMTP, but comparison is not reason. Satoshi Nakamoto's invention is not just a simple communication protocol. It's also a peer-to-peer network where a digital asset, Bitcoin with a lowercase b, is exchanged. In this case, it might be more relevant to look at how file sharing systems like BitTorrent, as well as the Tor network, have evolved. Even here, it's not a great success story. These tools have been overshadowed by highly centralized companies like Netflix or Spotify. Linux is also a very interesting case, the quintessential open source operating system. Linux remains, even today, one of the most favored platforms, if not the favorite, for many developers and software engineers due to its remarkable flexibility, exhaustive support for a multitude of programming languages, and powerful command system. Beyond development, Linux is widely used in various fields, including embedded systems, routers, and most consumer electronic devices. The world's most powerful computers, essentially for scientific research and complex simulations, run on Linux. A somewhat unsettling question remains: how many of you watching this video have had direct interaction with Linux? According to a September 2021 study, over 85% of people use Windows or Mac OS. Why is this the case? Just like with Gmail, Netflix, Spotify, and others, it's simply because they are prettier and easier to use. Fundamentally, using tools is a constraint. It's a constraint we accept to achieve our goals in our lives. Why don't people use Linux? Even if you use a user-friendly distribution like Ubuntu, it still limits your range of use because not all programs, especially video games, are available on Ubuntu. You'll inevitably spend more time managing your operating system than with Windows. In this case, Windows saves you time and offers a broader range of applications. Similarly, I'm willing to pay a mechanic to change my oil because my time is more valuable than my money. In this way, we see that our time is more valuable than many things. Our digital sovereignty lost with Windows, our privacy lost with most social networks, and even a good part of our citizenship, which we have ceded many rights over the years without much protest. And why? Because for many people, the priority is to maximize the time they spend with their family, at work, or on various leisure activities. Fundamentally, everything else is secondary as long as it doesn't have too much impact on our personal sphere. Revolutions, that is, questioning the established order to regain citizen sovereignty, only really happens when people are truly suffering. That's why it's very likely that the management of most people's Bitcoin will gradually be handed over to institutions like ETFs. Because in reality, financial sovereignty isn't impactful enough on the lives of 99% of the population for them to bother with managing their private keys. It's quite probable that in a few years, a large part of financial services will be based on Bitcoin, but 99% of people won't notice at all. And especially 99% of the population won't interact directly with the Bitcoin network. All the financial infrastructure will have been drastically simplified and optimized. But the ideas of individual sovereignty and the elimination of intermediaries will be nothing but distant memories. Like SMTP, the Bitcoin network will serve as a highway between the world's major financial institutions. These new value channels will speed up certain processes, reduce fees, or increase the margins of companies in the sector. The complicated part of Bitcoin, or at least what may seem complicated, will have been hidden or simplified to make users' lives easier. But like we said earlier, Bitcoin isn't just a communication protocol. It's also a digital raw material with its own inflationary policy. Whether we like it or not, BlackRock and all other entities accumulating significant quantities of Bitcoin in their reserves become major players in the Bitcoin ecosystem, with a significant potential for concentration of economic activity, and therefore significant influence on governance decisions of the protocol. For example, it's interesting to think about the influence of these companies in the event of a Bitcoin blockchain fork. Here's what BlackRock says in its ETF documentation regarding forks. In the event of a hard fork with the Bitcoin network, the sponsor, using its sole discretion, will determine in good faith which peer-to-peer network among a group of incompatible Bitcoin network forks is generally accepted as the Bitcoin network and should, therefore, be considered the appropriate network for the purposes of the trust. There is no guarantee that the sponsor will choose the digital asset that will ultimately have the most value, and the sponsor's decision may negatively affect the value of the shares. The sponsor may also disagree with the shareholders, the Bitcoin custodian, other service providers, the index administrator, crypto exchange platforms, or other market players on what is generally accepted as Bitcoin, and should therefore be considered Bitcoin for the purposes of the trust, which may also negatively affect the value of the shares as a result. Long story short, BlackRock is telling you that they will decide which chain is valid in the event of a fork, and which network has the right to keep the name Bitcoin and the orange logo. It's very important to remember that the economic impact of each actor on the Bitcoin network is not equal. For example, a local pizzeria processing a few dozen Bitcoin transactions each month does not have the same economic weight as BlackRock's ETF. The fact that many servers entrust the management of their Bitcoins to these asset managers centralizes power of influence over consensus rules in the hands of a few entities, rather than distributing it among millions of individuals. To draw a parallel, this dynamic was already observed in the case of the merge update on Ethereum. This change led to a fork fork in the blockchain. If part of the community did not want to switch from POW to POS, they were quickly discouraged from fighting when they saw the positioning of stablecoin producers. These mega users like Tether or Circle have a predominant economic activity on Ethereum, especially in DeFi. However, to maintain the peg of their stablecoin, they had to choose which chain to operate on, and their decision significantly impacted the legitimacy of the fork. If these few actors, along with other major players operating on Ethereum, had not chosen the POS fork as a legitimate Ethereum, the outcome of this update would likely have been radically different. Now, will BlackRock give a vote on Bitcoin protocol governance to those invested in their ETF IBIT, as they're starting to do with companies? Perhaps. It's true that when they think of the worst case scenarios, we often say they could do this or that. But who are they? Take the United States, for example. It's essential to recognize that this vast country is not a homogeneous entity where single voices dictate the course of events. The US represents a mosaic of voices and perspectives, a complex patchwork formed by millions of individuals with varied experiences, beliefs, and goals. The current tensions between Texas and Washington are yet another perfect example of this. The same goes for the questions around CBDCs or central bank digital currencies. Yes, the institutionalization of Bitcoin has moved a notch towards institutions, but to extrapolate the intentions of the US or major investment funds would be to project an overly precise foresight onto these organizations. They primarily have a great capacity to adapt to events that arise chaotically. The world is probably much less directed than we think, with each actor playing their role with the cards they draw randomly at each turn. However, it's important to remember why Bitcoin has value. What makes it useful in its current form? It comes down to its immutability, neutrality, and uncensorability. If you remove these, there isn't much left. Essentially, you would revert to what already exists, the SWIFT network and the dollar. That's why we often repeat that trying to domesticate Bitcoin is essentially condemning the technology in the long term. But beware, this doesn't mean we, collectively, won't go in that direction. The market can remain irrational longer than you can remain solvent. Now, some Bitcoiners argue that to defend the decentralization and uncensorability of Bitcoin, it suffices to develop a sufficiently dense and widespread economic activity to resist the influences of large institutions in the event of an attempted fork. In essence, even if a local pizzeria doesn't have the economic weight of a giant like BlackRock, the union of all pizzerias worldwide would create a counterbalance. The Bitcoiners' mantra: not your keys, not your coin, not your node, not your rules. Everyone, at their own scale, should thus avoid participating in centralization dynamics. In short, it's the hummingbird effect in crypto terms. Here at GCrypto, we really want to believe in this, and did a few years ago. But we're becoming increasingly skeptical. It's a bit like peeing in the shower or stopping eating meat to try to save the planet. We see the success of all these initiatives in recent years on CO2 emissions. We can already hear Greta Thunberg saying, yes, but at the same time, if everyone thinks like you, we're in trouble. And imagine what it would have been like if we had done nothing. But that's not the point. It's not the message. Just here at GCrypto, we think that if we really want to make a difference, we need to go to the root of the problem and have a global impact. If you really want to contribute to the decentralization of Bitcoin, then propose something else. For example, an alternative to ETFs, something cheaper, more secure, but most importantly, simpler than that. No, the future of self-custody won't look like a calculator from the 90s. Ledger has been criticized by some maximalists for their recover service, but in our opinion, it's precisely these kinds of solutions that might prevent total centralization of the technology. The product isn't perfect, sure, but it's an interesting compromise, and most importantly, it exists. And to preempt some comments under the video, no, we're not being paid by Ledger to say this. On the topic of improving user experience, we could also talk about account abstraction, which is gradually emerging and promises to change the management of crypto wallets, and especially the ability to reset your password, similar to what current Web.2 applications offer. The Liana wallet is also very interesting and promising for better self-management of Bitcoin, and it's developed by a French team. However, responses like, "Honey Badger don't care, Bitcoin is untouchable, Bitcoin is inevitable," can be dangerous, in our humble opinion, if of course the project is to change the status quo. As we've mentioned in one of our previous videos, if your vision for Bitcoin as a societal project is limited to its use by a small community of cypherpunks, somewhat akin to the current darknet, then yes, everything will be fine. We're not too worried about that. But is that really the project for Bitcoin to become the new Tor? Here at Gcrypto, we'd prefer not, but that seems to be the direction we're heading. Some might argue that even the internet in its current form has been a huge advancement for humanity. Information moves faster. In terms of business, productivity has skyrocketed. The possibilities of digital technology have profoundly changed our lifestyles. However, are we more or less free, more or less happy than in 1960? That's still up for debate. Collection and exploitation of personal data, personalization algorithms, attention manipulation, and targeted advertising. Today, everything is used to maximize user engagement and thus increase the revenues of GAFAM. Perverse model, certainly, but on the other hand, it has allowed for the expansion of the internet as we know it today. As Frederic Montagnon explained in his interview, the GAFA funded the infrastructure of Web 2.0. Data centers, UX, R&D. Without these cash machines like Google, Facebook, or YouTube, the internet would probably still look like this. The GAFAM might have been a necessary intermediary step, leading us towards a version of the internet that's more open, collaborative, decentralized, impartial, interoperable, and most importantly, more respectful of user privacy. This is often what we refer to as Web 3 or even Web 5. Bitcoin and cryptocurrencies might follow the same path, while ETFs offer an incomplete adoption of Satoshi Nakamoto's invention, not fully leveraging its potential. It's akin to pulling a Lamborghini with a donkey. It still represents a form of adoption. ETFs will likely draw millions of people down the orange rabbit hole. If you'd like to check out another video about one of Bitcoiner's champions, why not check out the one that talks and takes a deeper look into Michael Saylor's wild ride. If you ever wondered how a McDonald's employee rockets to the upper echelons of the financial universe, then take a look at this one. We will unravel the tale of Michael Saylor, the mastermind who bet big on Bitcoin and won. From his early dreams of soaring the skies to outperforming the crypto market with his billion-dollar brainwaves, this is one roller coaster ride you don't want to miss.